If you could automatically own the stock market's biggest winners, why wouldn't you?
Right. I mean, it sounds like an absolute cheat code for building wealth.
Seriously, you just buy whatever is already going up. But what if that cheat code hides some fascinating and honestly kind of terrifying vulnerabilities when the market's tides shift faster than your strategy can react?
It really is the ultimate double-edged sword in finance.
Yeah.
You're buying high with the express intention of selling even higher. But you are completely at the mercy of the trend.
Yeah, and when the trend breaks, the strategy can just break right along with it.
Exactly.
Which is exactly why we are putting that strategy under the microscope today. So, welcome to this deep dive. We are exploring the Invesco S&P 500 Momentum ETF.
Widely known by its ticker, SPMO.
Right, SPMO. We're going to unpack its highly anticipated March 2026 reconstitution, analyze the very real fallout from its controversial last two changes, and break down what financial analysts are forecasting for its performance through the rest of 2026.
And to get to the bottom of this for you, we are synthesizing a massive stack of sources today.
Oh yeah, lots of reading for this one.
Definitely. We've pulled the highly technical S&P index methodology documents, the ETF's own prospectuses, and financial news analyses from 247 Wall St.
But we also wanted the real pulse of the market, right? How people are actually feeling.
Exactly. So we're also pulling from active investor forums and running backtesting data from platforms like Bestfolio.
Because the premise of just riding the market's momentum is incredibly appealing. I mean, who doesn't want to just ride the wave?
Sure, but understanding how an ETF actually defines that word, momentum, is the absolute key to surviving its inevitable crashes.
Yeah, because as our sources show, momentum in finance isn't just, a general feeling of optimism.
Far from it. It's a strict, rules-based mathematical algorithm. SPMO does not care about a company's story or its charismatic CEO.
It's just cold, hard math.
Right. It tracks the S&P 500 Momentum Index. So out of the 500 companies in that broad index, it selects roughly 100 stocks that have the highest mathematical momentum scores.
Okay, let's break down that math, because this is where the engine gets really interesting. How exactly do they calculate that score?
Well, they'll look at a stock's price performance over a 12-month look-back period. But here is the critical twist. They intentionally exclude the most recent month of trading data.
Wait, they ignore the last 30 days?
Yep.
The freshest, most current data is just thrown out the window.
Yes, and it's actually a standard practice in momentum investing. It's designed to avoid short-term mean reversion.
Meaning what, exactly?
Basically, if a stock just had a random massive spike yesterday because of, say, a single news headline, it's very likely to drop back down tomorrow.
Ah, okay.
So the algorithm looks for sustained underlying trends over the prior year minus that highly volatile last month.
It's kind of like giving an Oscar to an actor for a brilliant movie they made over the last year, but completely ignoring the terrible, embarrassing flop they released just last month.
That is a perfect way to picture it, actually.
You're rewarding the long-term body of work, not the immediate recency bias.
Exactly. So once they identify those top 100 stocks based on that 12-month minus 1 month score, they have to decide how much of each stock to buy.
Right, the weighting.
Right. They do this by multiplying the company's float-adjusted market capitalization by its momentum score.
Let's pause on float-adjusted market capitalization for a second. In plain English, that just means they are only counting the shares that are actually available to trade on the open market, right?
Spot on.
They're ignoring the shares locked up by insiders, founders, or governments.
Exactly. It gives a truer picture of the company's liquid size. So bigger companies with stronger momentum get a larger slice of the pie.
Makes sense.
But they do cap individual weights. It's typically the lower of 9% or 3 times its market cap.
I assume they do this so one giant tech company doesn't accidentally balloon into, 40% of the entire fund.
Exactly. Plus, they enforce sector constraints to maintain some level of diversification.
And the appeal of this passive, rules-based structure is pretty obvious. I mean, it is highly cost-effective. The expense ratio is just 0.13%.
There's practically nothing in the ETF world.
Yeah, it's a huge reason why the fund manages roughly $14 billion in assets. But here is the massive catch that stood out in the documents.
The rebalance schedule.
The rebalance schedule. It only updates its portfolio twice a year, on the third Friday of March and the third Friday of September.
And that schedule is where the controversy really lies.
Right. Because if you're steering a massive cargo ship based on a weather map drawn a month ago and you only update that map twice a year, Aren't you basically guaranteed to steer directly into a hurricane if the climate suddenly changes?
Well, you might see it as steering blindly, but institutional indexers see it as noise
Noise
cancellation.
cancellation.
Yeah, a semi-annual rebalance filters out the daily chaos of the market. But you're definitely right to point out the risk, because academics have a very specific term for hitting that hurricane. It's called a momentum crash.
The momentum crash.
Right. According to our research on the mechanics of momentum trading, these strategies are highly vulnerable during periods of market stress or when sentiment shifts violently.
What are the actual mechanics of a crash like that? What happens beneath the surface?
It comes down to investor behavior. You get this herding effect where everyone on Wall Street crowds into the exact same winning trades. The momentum becomes self-fulfilling.
Everyone just piling in.
Exactly. But when macro market conditions suddenly change, maybe unexpected inflation data drops or a central bank pivots, those overcrowded trades begin to unwind simultaneously.
And then liquidity dries up.
Right. Everyone rushes for the tiny exit door at the exact same time, and the previous winners drop the absolute hardest.
And SPMO's rigid semi-annual schedule means it is structurally incapable of quickly rotating out of those fading trends.
It really can't adapt in real time.
It just has to sit there holding the bag and take the hit until the next third Friday of March or September rolls around.
Correct. And we don't have to look back to ancient history to see this theoretical vulnerability play out. We can look directly at the painful reality of what happened during SPMO's penultimate change in September 2025.
Oh man, that 6-month period from September 2025 to March 2026 was agonizing for holders of this fund.
Truly.
We saw retail analysts and active investors all over the forums noting that SPMO basically swung and missed badly. I mean, over those 6 months, the fund was essentially flat.
Yeah. In fact, it was down about 4% at its worst points.
While the broader market and its direct competitors were just thriving.
The culprits for that stall were pretty obvious in hindsight. SPMO was anchored to stale momentum.
Stale momentum.
All right, mega caps like NVIDIA and Broadcom had dominated the previous year, so they were locked in as the absolute top two holdings during that September rebalance.
But almost immediately after the lock-in, the market shifted.
Exactly. Those specific semiconductor giants exhibited terrible momentum for that exact 6-month window.
I want to bring you, the listener, into the psychological reality of this. Imagine logging into your brokerage account every single morning for 3 solid months.
It's brutal.
You're watching the rest of the market hit new all-time highs, but your quote-unquote momentum ETF is just bleeding cash because it's chained to 2 tech stocks that have suddenly run out of gas.
It is deeply frustrating for investors. And that frustration definitely boiled over on active investor forums where people started pointing to a completely different fund as the solution.
Right, FMTM.
FMTM, or the Focused U.S. Momentum ETF.
FMTM makes for a perfect foil in this deep dive because it takes the exact opposite structural approach to SPMO.
Yeah.
Instead of a 12-month look back, it uses a 6-month look back, so it's looking for more recent trend consistency.
And instead of weighting by massive market caps, it equal weights its 30 to 50 holdings, so smaller companies have just as much impact.
And most importantly, it rebalances monthly.
Yes. The performance gap between the two during that specific period was staggering. Since March 2025, FMTM returned a positive 48.8%.
That's massive.
Yeah. Its maximum drawdown, which is the biggest drop from peak to trough, was just negative 9.2%. And it recovered from that drop in a mere 28 days.
Meanwhile, SPMO only returned to 26.4%, suffered a negative 15.2% drawdown, and spent 87 days underwater.
87 days.
Every day a portfolio spends below its prior high is a day you are watching losses rather than compounding gains.
That 87-day stretch is the true psychological toll of a semi-annual rebalance.
See, I have to push back on the very nature of this fund then. If I'm buying a momentum fund, but my top holdings lose their momentum immediately after a rebalance, and I am stuck helplessly holding their heavy bags for 6 months,
Yeah.
isn't the label just misleading? If I'm losing 15% in a drawdown because the fund is asleep at the wheel, I am paying for it in lost capital.
It's a totally valid criticism, but to call it misleading kind of ignores the fundamental trade-off between passive index tracking and active management.
How so? Well, yes, FMTM outperformed in that specific whipsaw environment. But you pay for that activity. FMTM charges a 0.45% expense ratio compared to SPMO's 0.13%.
But, I mean, isn't the higher fee worth it if it saves you from a 15% drop?
Over a 6-month window, maybe, but over a decade. High turnover and constant monthly trading create massive tax inefficiencies, and that drags on returns in normal trending markets.
Okay, that's fair.
SPMO's philosophy relies on the long-term persistence of trends. It intentionally moves slowly to avoid getting shaken out of a good position by a temporary dip.
So it's a feature, not a bug.
Exactly. It just so happened that late 2025 was a highly volatile whipsaw environment where market leadership changed rapidly. When trends chop and change that fast, the semi-annual methodology stalls.
It's a feature that temporarily backfired.
Right.
So if this rigid 6-month schedule caused them to bleed out over the winter, the highly anticipated rebalance on the third Friday of March 2026 must have been an absolute bloodbath.
Oh, totally. The entire investing community was watching to see if SPMO would finally cut its losses and course correct.
And the data from Invesco's March 23rd portfolio update confirms it was a massive overhaul. Out of roughly 100 stocks, only 43 were retained from the previous period. They completely gutted the portfolio.
Only 43 survivors. It's like a sports franchise firing half its roster overnight.
Pretty much.
But here is what blew my mind when I read the documents. Despite the terrible 6-month slump that dragged the whole fund down, NVIDIA and Broadcom actually survived as the top two holdings.
They did survive, though their influence was notably reduced. NVIDIA dropped to an 8.23% weight, and Broadcom to 7.19%.
Still, they kept the captains.
They did. But the real story isn't who stayed at the top. The most profound takeaway from this document is the list of additions and deletions.
Because it tells a clear story about where macroeconomic momentum is actually shifting.
Exactly.
The deletions were ruthless. They completely dumped former giants. Meta, which previously held a massive 7.4% weight in the fund, is completely gone.
Just wiped from the roster.
Along with JP Morgan Chase, Walmart, Netflix, Visa, Oracle, and CrowdStrike. Just gone.
Now look at what replaced them. They added massive players across entirely different sectors. Yes, they brought in Alphabet, both share classes plus AMD and Micron to bolster the semiconductor space.
Right.
But the really telling additions were companies like Caterpillar, Coca-Cola, ExxonMobil, and Johnson & Johnson.
Drafting Exxon and Caterpillar while dumping Meta and Netflix, that is a violent shift in the portfolio's DNA.
It drastically reshaped the sector breakdown.
Yeah, technology still dominates at 33.31%, which, makes sense given the ongoing artificial intelligence narrative. But financials are now a hefty 19.74%, communication services sit at 14%, and industrials have surged to 12.13%.
This broad rotation reveals a crucial pivot in the broader economy. If we look at the underlying mechanics of what drove these stocks over the last 12 months, we are seeing a blending of pure tech with traditional industrial stalwarts.
Why did momentum suddenly favor industrials and energy over consumer tech? Why the shift?
Because the nature of the AI revolution is maturing. We are moving past the initial software hype phase and entering the physical infrastructure phase.
Okay, that makes sense.
The momentum factor is entirely agnostic. It doesn't care about the story, it only cares about price action. And the price action dictated that capital is flowing toward the companies that actually build things.
Right. It's the physical reality of the digital boom. The market is essentially saying, yes, we still believe in the AI revolution, but you can't run a billion-dollar data center without massive power grids, advanced cooling systems, and raw, heavy machinery.
Absolutely.
You need the Caterpillars and the Exxons of the world to physically build and power the infrastructure that the tech sector relies on.
Precisely. The algorithm captured that subtle, beneath-the-surface shift from software to hard assets, while everyone else was distracted by the daily noise of tech earnings.
Okay, so now that we know the players on the field for the next 6 months, this new hybrid tech and industrial roster, what are the financial analysts forecasting for SPMO's future through the rest of 2026?
Well, the sentiment is deeply divided, and it really depends on what kind of timeline you are looking at. According to analysts at 2047 Wall Street, the sentiment is incredibly strong for long-term holders.
Very bullish.
Yeah, they expect SPMO to, quote, win again this year.
And to be fair, the bulls have history on their side. The 10-year data is undeniable. Over the last decade, SPMO has posted a 416% gain.
That's incredible.
Right. Over that exact same period, the S&P 500, represented by SPY, gained 222%. SPMO almost doubled the broad market over a 10-year stretch.
Furthermore, the bulls point to a very counterintuitive fact about how this fund handles sudden chaos. During the 2020 COVID drop, which was one of the fastest, most violent crashes in market history, SPMO actually held up slightly better than the broader market.
Really?
Yeah, declining 31% compared to SPY's 34%.
But we have to add context to that. It survived the COVID crash better because at that specific moment in time, its 12-month look back had already loaded it up with high-quality tech stocks.
Right, the work from home stocks.
Exactly. When the lockdowns hit, those exact tech stocks were the only things that thrived. It was partly structural, but it was also incredibly lucky timing.
That is a very fair assessment. Which brings us to the cautious and sometimes outright bearish sentiment we found from active investors and backtesting platforms.
What are they saying?
They warn that 2026 could be extremely rocky if the current market choppiness persists. They point out that SPMO's Sharpe ratio currently sits at 0.82.
Let's explain that for a second. A Sharpe ratio measures risk-adjusted return. It essentially asks, how much extra volatility am I stomaching to get this return?
Right.
And a Sharpe ratio of 0.82 isn't terrible, but it's not stellar. It means it is absolutely not a smooth ride. You are taking on significant turbulence to get those 416% 10-year gains, including a historical maximum drawdown of -31%.
And the critics highlight the fundamental, inescapable risk of 2026 for this fund. SPMO is always long equities. It constantly rotates within the stock market, finding the fastest-moving stocks among the S&P 500. But it never moves to cash. It never moves to bonds when the broad market momentum turns negative.
Wait, so if the whole economy decides to tank in late 2026, if we enter a true prolonged bear market, SPMO doesn't have a parachute.
No.
It just mathematically finds the fastest sinking ships and rides them to the bottom.
That is the ultimate structural risk of pure equity momentum. Market corrections don't make capital disappear, they redirect it.
Right.
If 2026 brings a sudden macroeconomic regime change, the algorithm will just find whatever stocks are crashing the slowest. SPMO's static semi-annual approach means it cannot save you from a macro market collapse.
You're just stuck.
You would just have to weather the storm, fully invested in dropping equities until the next rebalance in September.
It's like being on a sinking cruise ship, and the algorithm's only job is to move your deck chair to the highest point on the ship.
That's a grim way to look at it, but yeah.
You're still going down, you're just the last one to get wet.
Which emphasizes exactly why investors absolutely must align this specific fund with their own personal risk tolerance. It is a highly powerful tool for compounding wealth over a decade, but it is not a set-it-and-forget-it core holding for someone who is going to panic and sell during a steep 3-month drawdown.
That is such a vital takeaway. So let's distill this entire deep dive for you. SPMO is an undeniably powerful, low-cost engine for capturing market winners, yielding massive 10-year returns that absolutely crush the broad market.
But its rigid, twice-a-year rebalancing schedule caused a very frustrating stall in late 2025 when it got caught holding stale tech trends.
Which then led directly to that dramatic roster shakeup we just analyzed in March 2026. The fund pivoted heavily, reacting to the maturing AI landscape by mixing semiconductors with traditional industrial powerhouses like Caterpillar and Exxon.
And the reason you should care about all of this, it's a stark reminder that passive investing isn't truly passive when you're tracking a specialized factor like momentum.
You aren't just buying the market. You are effectively hiring a mathematical algorithm to buy high and hope it goes higher.
Exactly.
Understanding the rules of that algorithm, like the 12-month look-backs, the float adjustments, and the exact dates it rebalances, is the absolute only way to avoid panicking when the market inevitably whipsaws.
You have to know what is under the hood of your portfolio. If you don't understand the mechanics of the engine, you are going to abandon the car at the first sign of engine trouble.
Which leaves us with a final, lingering question to explore on your own. We live in an era where artificial intelligence algorithms can track sentiment and trade market momentum by the millisecond.
That's true.
In a world of high-frequency trading, is a semi-annual 12-month look-back ETF actually a dinosaur, a relic of the past, or, wait, I shouldn't say a word like that. Does that intentional slowness ironically protect you from the chaotic, exhausting noise of modern hyperfast trading?
Sometimes the best move you can make in the market is actively choosing not to move at all.
Thank you so much for joining us on this deep dive into the mechanics of momentum. Keep questioning the algorithms, and we will touch you on the next one.